Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So let's continue our discussion, reading and discussion of Jack Schwager's Market Wizards.
Let's get into it with the rich dentist.
With the rich dentist?
I mean, Richard Dennis.
Oh, Richard Dennis. Yeah, so after reading Richard Dennis's chapter, or the chapter on Richard Dennis, my first reaction was I didn't like it that much.
Oh, you didn't?
I didn't like it that much.
This is my favorite.
Okay, so I thought about why I didn't like it, and I went through it closer, and I realized why I didn't like it, and I completely changed my mind to liking it a lot. And the reason why, do you want to talk about why it's your favorite right off the bat?
Oh, it's just purely about trend following, which is essentially what we do. I mean, he was a futures trader, but we're trend following with ETFs. It was just pithy. It was just full of good advice, full of anecdotes that resonated with me. And his is a great story. It's the trading places story in real life.
So that's what I realized why I didn't like it, was that it was full of pithy advice that's so foundational and so basic that I was taking a lot of it for granted.
Sure.
I was just reading and being like, yeah, of course. And now, of course, when he was saying it, he was one of the real early birds and discovered it and codified it.
Yes, he codified it.
So it's of course to me because of guys like him.
Yeah.
So it took me a closer reading to realize how important it was, even though it's so fundamental. And then the second thing of it was realizing, even though that it's so fundamental and so basic, even after knowing that and practicing a good part of it for a lot of years, I still stray away from things from the foundation. And when realizing that, I realized how, there's things I stray away from, and that's what. I can know the fundamentals, know that it's great, but I'm not good enough to stray away either. That's the.
Everybody violates the 10 Commandments at some point.
Yeah, and I think that's where you get into trouble. And I think there's a little bit of a background that we can discuss about Richard Dennis. Maybe it's now's the appropriate time, but you
think he broke his own rules in the end?
Right. There's this question mark of what happened. In the 1987, he was one of the largest traders in the country, and he was personally worth somewhere, they say, about $200 million, which is a lot of money, but was a lot of money back then.
I think it was 300, and that would have felt, so purchasing power would have been over $1 million or $1 billion today. But in terms of what it felt like, in terms of how many people in the country had that kind of money, I mean, it would have been
very few.
5 billion. I mean, just a handful. Just
very
a handful.
Few.
It would have been like 5 billion today. He would have been
in liquid
money. In liquid money. Nobody had that kind of money.
It wasn't.
Soros had it, and Buffett had it, but
yeah, it wasn't that many. So
that was his money too. That wasn't his fund. That was his money.
That was his money, and then he lost a lot.
Yeah,
50% of it, and it looks like he cut out, and I don't know if that was in the framework of his rules and his rules allowed for him to losing 50%, or if he violated his own rules. And I think, sometimes you do that. And I think there's some stories that's what he did, that he's a trend follower, but sometimes you get lured into counter trend following. Or into your, and this is where I was gonna get, this lets into I want to give you four quotes, which are all together. It's a little bit long, but this is to me was super critical aspect of the chapter. So one is, you should expect the unexpected in the business. Expect the extreme. Do not think in terms of boundaries that limit what the market might do. Okay, that's one point. Then another point is, the biggest fallacy is that markets are supposed to make sense. And then the third one is when he starts talking about, gets in the realm of codifying trend following. A good trend following system will keep you in the market until there is evidence that the trend has changed. The correct approach is to say the structure means up, and this structure means up, and this structure means up no more. But never that this structure is up this much and no more. That's a little mess up. The correct approach is to say the structure means up or the structure means down. I cut and pasted it, and that should say the structure means up and the cut structure means down. It should never say the structure means up and no more. And then this gets it. This I want to just bring this in because it's all part of the same discussion. But I have mental pictures, but I try not to use them when I'm trading. Trading to me is like betting on independent rolls of the dice that you think are loaded a little bit in your favor because you know some statistical things about the market. Long-term scenarios can prove to be right or wrong, but even if they're right, on balance, I'm not convinced that they make much of a difference over the term of an individual trade. So the lure, what happens is that you think you know, this is the point, the stars line up and you know better than the markets. And I think maybe that's why he caught, maybe this is speculation as to what happened, but so maybe it's not worthwhile going. But I know from me individually, what happens is that you know that the foundational rules is let your winners ride. The market can go up higher than you can imagine, lower than you can imagine, and have risk some form of risk control, some form of hard stop loss. Cut your loser. And sometimes though you think that, oh, you have an opinion. You have an opinion about where things are going to go, or the way the world is, and how the market isn't making sense in the world, and you get lured into making a bet. And that is that is the danger, and sometimes you think that you know the foundation, you know the rules, you do the rules, but I'm above the rules. I can get away with this, and that's when I've lost the most money. So that let me stop there. I have a lot more points to add in this realm, but do you have any commentary in this realm?
I agree. Your opinion is what gets you in trouble. I think we'd all be better off if we never knew what we were trading.
And that's
if you're trading sugar and you kind of know the price history of sugar, you know what it costs to produce a pound of sugar. You know how high it's been in the past, how low it's been in the past. When it starts making new highs or new lows, you're going to dismiss them. You're going to say, this is impossible, it has to stop, it has to reverse. It doesn't work like that. The market is not rational. The market doesn't care about, well, within any time frame that matters as far as your account is concerned. The market doesn't know any of the things that you know. It doesn't care about those things. And so you may be smarter, you may be right in the end, but there's this quote that's attributed to John Maynard Keynes: the market can stay irrational longer than you can stay solvent. It was true in the 30s, and it's true today.
So that's the delineation between. There's a lot of opinions out there, and my opinion in reality is no better than anybody else's opinion. And what happens is your opinions sometimes creep into your trading, and sometimes you feel your opinions are so strong and the stars are so aligned that you can break a little rule here or there. Meaning, I know where this is. This is lined up. I can run this one without a stop. I lost a boatload of money in 2014 when I started bottom fishing in the gold sector. I avoided the 90% fall. The market fell 80%. I avoided the 80% fall down, and I thought, okay, market's down 80%. I didn't get damaged at all from it, and my area of focus was the precious metal sector. I didn't get hurt at all from it. It's down 80%. I can jump in. A lot of the damage has been done. I didn't really have a clearly defined stop loss, and it fell another 10% from 80 to 90%. But when a stock goes from 100 to 20, that's down 80%, and 20 to 10, that's 50%, like that. And that was a mistake because I thought I was too smart, it was hubris to think that you got this one and you can kind of wing it. And
yep, that index went, the index was below where it was in 1985, wasn't it? It was ridiculous.
Yeah, well,
but that can happen. That's the kind of thing that you can't rule out those extreme possibilities. They do happen.
I saw this, Jerry Parker had this great quote. I don't know if it's his own quote or he re-quoted somebody on Twitter the other day or past week, but was, the market is a history of unprecedented events.
Yeah.
And, and this goes, this dovetails into a lot of things, but, my friend had a saying, he had one which I really liked was, the problem with life is not that it's too short, it's that you have one iteration at it. And so when you combine the set of unprecedented events with only having one iteration at it, you have to have some framework that allows for these unprecedented events, because you don't get to do it again. The time passes and it happened, and that's it. That's history now.
In most realms, there are strict bounds of possibility. You're never gonna see an old Toyota Camry pass you at 200 miles an hour on the freeway. Things don't fall up. Everything stops when it hits the ground. There are a lifespan is 115 years on the outside, and you know what the probabilities are. They're bell curves. Everything's a bell curve, right? But in the markets, you're dealing in the world of price. That's your world. You don't have biology, you don't have physics, you just have price. And price is an abstract thing. It's in its own universe. And there are not really rules. There are rules about how to play in that universe, but those rules are designed to protect you against the fact that that universe has no rules like the rules that you know. You are not evolved for that world, for that environment. So you have to be very, very careful. You don't know what's going to happen. It's like there are other dimensions and you can't see them.
So this lends itself a little bit to what Bruce Kovner said in the last one, is that he has a model of both ways, really. Let's say the bear case model and the bull case model. And if things start going towards the bull case, he will say that okay, he just follows the trend, but in his mind the bull case is giving him the framework or what's the word I'm looking for? The willingness to go with it. Gives him the foundational, what he believes is the fundamental view to go with that. Because sometimes it's just. But what my takeaway from that, and it's work in progress, we'll realize. But I almost feel like it doesn't matter what the bull case or the bear case is. There is one. We don't need to even know it. It's there. And just because I can't think of it doesn't mean it doesn't exist, and that's what makes a market. There's two sides for every trade. That's why it trades.
Opinions make markets.
Opinions make markets, and what I'm realizing is that I got to get all my opinions out. Like there's no place anymore, and I got the solution for it, because I'm a gambler at heart, and I have to make my bet. I can't not do it. So what I'm doing is going to have a very small account.
Perfect. That's the solution.
Very small account that accepts that trade, and I mean tiny, and that's my release for my opinion.
There you go.
But it does not go in
there you go.
the 99% of capital.
That's the way to do it.
So what I first glossed over at Richard Dennis's being, an obvious chapter, but that's the value of close reading and discussion. Mm-hmm. Is that it's not just it is so obvious after 20 years, but there's still. I'm still doing it. Well, I'm still doing it wrong, and I'm sure there's people who get tempted. Even big guys who get.
It's really hard to follow the rules. We know the rules. The rules are so simple, but it's hard. That's why you need quant. You need to commit yourself to a quant system. But so there's a flip side to that phrase. The phrase "markets make opinions" means, you know, I think Exxon is worth 90. You think Exxon is worth 80. So, you know, we're going to transact at 85 and think we're each going to win. But there's the phrase "opinions make markets." No, that's opinions make markets. I'm sorry. The other phrase is "markets make opinions." You know, take 2014. The resource sector crashed. Oil in particular, I remember the numbers. It was like 100 in June, and by December it was under 40. So what changed? Did the supply and demand situation completely change in 6 months? Of course not. It was just opinions. Opinions changed. Price changed. Price changed. Now, the vast majority of traders, of investors, finance gurus, would have had a good story for why oil was worth $100 in June 2014. You know, some would have made the bear case for 85 and some would have made the bull case for 120. But a move to below 40, that was outside the realm of possibility. But as soon as it moved, everybody had the explanation. Everybody believed in this explanation. Oh, it was the, you know, this glut of shale oil and, you know, efficiency of new efficient vehicles and moving towards a cleaner, greener world. And this whole story was then adopted. But the fact is, the story you could have told either, if you didn't have the price and you just had these two different stories in the world of 2014, you could have believed either one. And people came to believe one when the price was this and the other when the price was this. The fundamentals didn't change, only the price, and then the story followed the price. So markets make opinions.
Yeah, I got one which is in the slim run, sentiment follows price, that's one of the, on a tangential note, that's one of the reasons why I don't really love sentiment as a indicator.
Yeah, I used to be a big fan of sentiment, and it may have some value at extremes, but the problem is that sentiment can stay extreme for a long time. The majority can be right for a while. At extremes of price, in retrospect, if something ends up being a peak or a bottom, you're going to see in retrospect that the vast majority of people were bearish at the peak, or bearish at the bottom and bullish at the peak, the exact opposite of what they should be, or of an opinion that would have helped them. But people can stay bearish. People can get bearish in a falling market, and that market can continue to fall despite the fact that most people already believe it should fall. And people, like we've had this year, people have been bullish for several months now. The majority of traders have been bullish. And just because everybody thinks the market's going to go up already, everybody already thinks the market's going to go up, they can still go up for quite some time. So yeah, sentiment's hard to trade on. It gets back to price. Price is the only thing you can consistently trade on that keeps you out of trouble. And also, I think if all you have is price, it forces you to have that discipline, because you can't make up a story. If you don't know what you're trading, if you don't know what the history of that thing has been, if you don't know if it's a stock, what its earnings are, if you don't know anything about what you're trading, then your system has to be tailored for anything to happen. It has to be able to accommodate a far wider range of possibilities, and it has to be more deferential. You can't second guess price if you don't have any reason to disbelieve price. All you have is price, so you got to believe it. So there's a lot to be said for being an agnostic, being, having no opinion whatsoever.
So that's a very hard concept for non-traders to appreciate. So, which is probably majority of the world, and definitely majority of the world. So, and goes, flies in the face of the way the whole investment world is structured. And so, this is when you run an asset management business, this is the dilemma, right? Is that you have to do what's right, or what you have to do what you believe is right, but to raise AUM, to raise money, to raise capital, you can't sound like the kook.
You have to speak the language of humans, and humans think in stories. Stories resonate with them. That's just, we're not adapted for this other world, and we need a language that conveys how that world works. And we have it. I mean, it's trading aphorisms, and all these aphorisms like "don't fight the tape," "let your winners run, cut your losers short." They're advice for how to behave in that other world. And I like stories about things that have happened in that world, but they're all about how to be an actor, how to be an actor in this world of price, because price is all that matters in the end. It's your account value. So let's see what else did Dennis. So the story is, there was I don't know if this is somebody said this. This is a true story. On the board on the Chicago exchange, I don't know which exchange this would have been in Chicago, the futures floor, somebody would often would see a big transaction go, 500 contracts of soybeans or whatever, and he'd say, "Whoa, who is that? That was a big trade in 1982." And you'd hear Rich Dennis. "Oh, it was a rich dentist? Who is this guy?" You kept hearing Rich Dentist. No, it was Richard Dennis. Richard Dennis. He had maybe the greatest run in percentage terms of any of the people we're talking about today. He got a job as a young man as a runner, I guess, taking paper tickets from one trader to another, from a trader to a bookkeeper on the floor of the exchange. Saved up $1,600. Would have been this was the early 70s, 73, 74. Bought a seat on the exchange for $1,200. And took that $400 as his stake and started trading. He compounded his money. I don't know if there was more contributed there, but he compounded his own money, starting with a $400 stake to $300 million within 15 years. I haven't done the compound annual growth calculation on that, but it's got to be a record.
And those are the stories that attract the ambitious young person to the market.
Mm-hmm. So we haven't even talked about what Richard Dennis's claim to fame, aside from such a great record. What he did is define futures trend following. He and his partner had an ongoing discussion about how much of what they did could be systematized, how well it could be defined, how much was due to intuition or special talent. Dennis believed that his rules were that he could distill it down to very simple rules, and provided somebody had the adequate intelligence and drive and discipline, make them a competent futures trader. So he took out an ad in the newspaper, I guess it was the Wall Street Journal and maybe some others, offering a job opportunity to trade under him, to work in his office. And he was a big name. This was 84, 85, around that time. So he was a known person in finance. And so people saw this ad, Richard Dennis, and they said, you know, he got a pretty good response. I think he got 1,000 letters in response. He whittled it down to, I think, was it 10, 12 in his first class?
I think they ran 20.
Was it 20 in all, 10 in a class? But just a handful of people.
No, you're right. They interviewed 40 people and they picked 10.
Okay. So he brought them out to Chicago, gave them a 2-week crash course. That's it, 2 weeks. A lot of them hadn't even traded before. Some of them were champion board game players, a chess player or two, blackjack player or two. There was one, I think the one woman had been a stockbroker, but these were not futures traders. He chose them for intelligence and whatever other characteristics he was looking for.
Well, in that specific realm, he said he didn't even think intelligence is a critical aspect.
No.
He just said
there's a threshold, just like Buffett said. There's a threshold.
But they had so many really off the chart intelligent people that were just available, so they took it. They weren't necessarily screening for the highest intelligence, but they had it available, so they took.
Right. He said, given a choice between an intelligent and a really intelligent person, he'll take the really intelligent. May as well.
Right.
So, trained them for 2 weeks, and then seeded them with a good chunk of his own money. And so long as they followed the rules, they didn't get in trouble. There's a great book about this. The whole story is written up by Michael Covell in a book called The Turtle Traders. It came out in the mid-90s. But these guys were trading with crazy leverage. It seemed everybody traded with big leverage back then. I mean, it's the only way you can generate that kind of return, by taking on outsized risk, a kind of risk that will eventually blow you up sooner or later. But it might be a while before you blow up, so you can have a pretty good run in the meantime. I mean, these guys would double their money or better in a given year. So if you're doing that, I don't care what your system is, you're gonna blow up sooner or later. But anyway, they didn't have blow-ups their first year or their second year, not as a group anyway. And so long as these guys followed those simple rules, and it was a really elegant system. It was, they had their list of futures contracts, their agricultural commodities, their industrial commodities, your interest rate futures, maybe they were trading currencies. I don't know if they were trading indices or treasury bonds. But anyway, you had all your different futures contracts, and for each one, you would calculate a range, a recent range, and then they would trade breakouts, either bullish or bearish, from that range. So a new high, highest close in the last 40 trading days, lowest close in the last 40 trading days. Then you take a position sized according to the volatility of that contract, and with a stop set so that if the trade went against you, you would know how much you're going to lose in each trade. This is all key stuff. Any trader will do this. You have to know what your potential loss is for any given trade, and set your stops, hard stops, by the way. So you have to take that loss if it goes against you. Set your stops so that a series of unlucky trades, which is going to happen, is not going to set you back too far in the hole so that you can't recover. So he had them run these rules, and they all did well. And I think on average they doubled their money in the first year. And then he had a second class come and do the same thing. Called them the Turtle Traders, because he said, the story is, he saw a turtle farm in Singapore, and he said, I'm going to train traders like they grow turtles. So it worked, and a lot of those traders went on to become successful fund managers in their own right. Probably the biggest today, the guy with the longest invest record is Jerry Parker. He runs a firm called Chesapeake. And he ended up having to dial down. I mean, after he got out of, I guess he saw Dennis's blow up, and then he got out on his own and wanted to raise institutional money. And he dialed down the leverage big time to target an annual return of 12% rather than doubling every year. And by targeting 12, he could bring down his downside so that his worst years ever in the 20 or 30% range down, losses of 20 or 30%, which is a pretty darned good risk-adjusted return. It's about the best in the business. There really is nothing like trend following for a risk-adjusted return. I think it's because of two things. It's diversified, and you have to have those hard risk controls. You have all these different contracts. The coffee market has nothing to do with the interest rate market. Gold has nothing to do with lumber. These are all trading on their own. At any given time, you're going to have trends on the bear side and trends on the bull side. And the way you size your positions, it doesn't matter how volatile something is, because you're going to buy more contracts of the euro dollar than of the gold market. And you just have, with all of these different contracts, this whole world of prices. At any given time, you're going to have some nice trends to capitalize on, and you're going to have winners and losers that offset one another enough so that you don't have this correlation that you do in the equity markets or in other risk markets. So there's really nothing like trend following in futures, except for what we do, which is we've only been able to do with ETFs because of the wealth of options that have become available in the last decade or so. But this is what we do is it's kind of an adaptation. Some people say that momentum is what we do and trend following is what they do, but it's the same thing. We're all trading momentum. We're all using hard risk controls, and we're all using a diversified universe of investment possibilities. But Dennis was the first to get credit, at least, for quantifying his rules, for distilling down some very simple rules and following, for eliminating the mystique, the genius. The genius was in the ability to distill the process. But that's Richard Dennis.
You said something along the lines, it's scary how well it worked.
Yeah.
So this is a line that he said that I'd like to discuss. He goes, the worst thing you can do is miss a profit opportunity, assuming you're already disciplined enough to cut your losses. Mm-hmm. And if you think about it, rigid long-term views are the kind of thing that most likely lead you to that mistake. With the area that I want to, I guess, spend a little bit of time on, your thoughts on the worst thing you can do to miss a profit opportunity.
I agree with that. You need your profits to offset your losses. All right. In a sense, it's as bad to miss a profit as it is to take a loss, because you're going to take losses. You can't avoid that. If you're doing everything right, you're going to take losses. You're going to take lots of losses. Those losses should individually be small, but at times you're going to have a string of bad runs. You're going to have a run of losers. You can flip tails 10 times in a row. That'll happen. You play the game long enough. So you're going to take losses. And how do you get ahead if you don't make up for those losses? Any system needs its winners as much as its losers, and its big winners its big winners are going to be your biggest surprises. They're going to be the things that you did not think were possible. So yeah, like the stock market this year, huh? We've been talking about how overvalued it is for all year, and here it's had a great run. It's been huge. Our flagship strategy has been long stocks, despite our better judgment. It only looks at price, so it's a better trader than we are. So and you need those. Yeah, you need those runs to make up for years like 2015, where, it had a string of losses. It had losses in bonds, and then REITs, and then stocks. That was a bad year. It did everything right, but it took little loss after little loss, and it lost money. So you need years like this. You need gains like this, which can come. They can come from anywhere, and you never know how high a market can go.
So in that framework, it's a really important concept, right? Is that the worst thing you can do is miss a profit opportunity, because you need those big winners to pay for all your little losers. It's the same.
This is a mistake that most individual traders hold on to their losers out of hope or denial, and they harvest their profits. Oh, something's up. Great. Let's lock in that gain and look for something else that's going to win. Look for my next winner. But no, that is your winner. That one's moving. Stay with it.
That person is playing the game of being right.
Yeah.
And they're locking in they want to get an A in school.
Well, that's a score. You take that profit. That's a win.
Right. It's a win now. And on the flip side, the loser's not a loss until.
That's right. That's right.
So, but now I'm spent a little bit of time thinking of that question of the worst thing you can do is miss a profit opportunity in this way. So tell me what you think about this. So one of the things that Paul Tudor Jones or who we're going to discuss in the next chapter said something after the financial crisis, and maybe, I don't know, he said in 2009 or somewhere, 2009, 2010, 2011, somewhere he said, I missed the subprime crisis. I should have got that one. And I thought he was being a little bit tough on himself, because you can't get it all. I remember thinking that at the time when he said I should have got that one. Then the other thing that's contemporarily happening is the cryptocurrency run, and I'm not participating in it. And the question is it a sin to be missing big moves in the world like that?
That's a good question.
So I'll give you.
I see what he says. I agree when it comes to the subprime thing. I got that one, right? That's the biggest. That was my biggest win. So it was obvious to me, and you'd think that somebody in the position of Paul Tudor Jones would be able to see it at least as well. But cryptos, so I missed that one, even though I saw it. I've been aware of cryptos probably longer than the vast majority of people who've made big money in them, because I was kind of a libertarian gold bug. So I was aware of Bitcoin way back when. Most people didn't become aware of it until 2013. And I was aware of it when it was $1 or less. I remember it was a story on Zero Hedge back in like 2009 or maybe 2010. Should I have seen it coming? It's hard to say. I mean, it's been an exponential growth, not just of price, but of the network effects of people who know about it, who understand it, who believe in it. That's what's driven the exponential growth in price. But it wasn't as clear. I mean, in retrospect, it looks clear. Okay, the housing market, this is a giant market. It was the center of the bubble. here we are in Miami. I mean, this whole economy was frothy and depending on real estate speculation. In New York, all the banks were making money on packaging and selling mortgages. And I mean, the real estate was at the center of the economy for years in the early mid-2000s. So I think that was a far more obvious play.
But
because it was just so big, it was everywhere, and you just had to look around you.
But that's when we get into the world of analysis and opinions. If we're slaves to price, and Bitcoin trades on a market like all the cryptocurrencies trade on the market. So I looked at trading.
If you're slaves to price and Bitcoin is on your radar of something you might buy, then yeah, you buy it when it goes into an uptrend. But it wasn't on anybody's radar. My point is that it was this concept, this like theoretical entity that you could buy somehow if you knew how.
But you could buy it. I mean, anybody could have bought it.
Way back then, it was not easy.
So this is my.
And let me finish my thought here.
Sorry.
You don't know which trees are going to grow to the sky. At any given time, this is like which startups are going to make it and be massive companies. At any given time, there are tiny little things out there that are going to get big. But there are a lot of those things out there. So it's hard. It's much harder to pick those. It's much harder to pick those than to look at a major disbalance in the economy and say that it can't go on. I mean, it's right in front of you every day. Everywhere you look, everybody around you is involved in it somehow. You have an established history. You can look at the Case-Shiller home price index and the relationship of home prices to incomes, to rent. You can see how much people are putting down on homes, what kind of mortgages are being done. You have all these references, whereas, yeah, who's to know that this big thing is going to be, that Bitcoin is going to be this big thing? So, I don't know, I forgive myself.
So, if you look at it in that way, which is that it's one of the many things in the world that who knew what it was going to become, then I think it's fair to say you missed it. So the way I'm torn between this and I'm not going to spend much time on beating myself about it, but because it doesn't serve any value, but just in the idea of just thinking about these things. So I looked at trading cryptocurrencies with the turtle method maybe a year and a half ago, and I used the Richard Dennis's rules on Bitcoin in the past, and it would have been a pretty good construct. It would have worked. Yeah. It would have been a profitable methodology, and ultimately I didn't do it. I didn't ultimately run any sort of trading on any of the cryptocurrencies because my concern was the reliability of the exchange. I think around then Mt. Gox got robbed for $50 million or something like that. So my thinking was, okay, I can run this method, but I don't know the reliability of the exchange. So that's where I forgive myself, is that I don't say Bitcoin is the same as the stocks.
It also had very wide, huge volatility and big spreads. It would have been hard to trade. I don't know if volatility and spreads have come down in the last year. You would hope, as the liquidity, as more people have gotten involved, trading volume must have picked up, and I'd imagine that the spreads have tightened and it's become cheaper to trade. But it's still very volatile. But just because something is really volatile doesn't mean you can't apply these rules to it. You just have to have wider stops.
Right. You just have your average true range is higher, and so what you calculate your stop losses.
That's right. No, it does. I mean, it does trend nicely. I mean, it has had these parabolic rises, crashes that retrace a large fraction of that rise, a period of languishing for a year or two, another parabolic rise to the next order of magnitude, a crash, a languish. It's been around for 7, 8 years now, so it's gone through 3 or 4 orders of magnitude, and who knows how many more of these it has to come. So yeah, it's a funny thing. It's on everybody's mind right now. Everybody's wondering what it's worth. I hear a lot of utopian talk about how it's going to replace the dollar, about how it's going to restructure the financial system, alter accounting forever. I don't have the ability to assess these claims, but what I do know that it's not widely used at the moment. Okay, well, people will say that means that it can just get that much bigger, because it's hardly being used at all. Look where it is. So where's it going to be once everybody uses it? Once it's easy to use. But as a trader, I know that what's driving it is not the fundamentals. That this is a mania. It is being driven by people's enthusiasm and by the lure of quick profits, big quick profits. And that's what's driving the price. That's all you need to know. It doesn't look any different from any other chart. And on a time frame of a year or so, it's gone up 10 times in a year. Is the Bitcoin world, are the fundamentals 10 times more valuable? No. No, the bulls will say that the fundamentals are $1 million of Bitcoin. How do you even know? How do you know? All right, so it's a store value. It can be a store value at $100, at $10. It can be a store value as a store value for a lot of people, you will want it to be higher, to have a higher market cap. So what is the market cap of gold? It's about 4 trillion, is that right?
Yeah.
What's the market cap of Bitcoin? 20 billion? Is it 200 billion now?
I don't know.
We ought to know these things. But so yeah, from that point of view, from the store value point of view, if you want as many people to store some fraction of their net worth in Bitcoin as they do in gold, and perhaps that is a genuine fundamental bull case, because for them to do that, it would have to be bigger. But it's so much harder to buy Bitcoin than it is to buy gold. But then as it gets easier, yada yada, I don't know. It's just I wouldn't feel the same as an ounce of gold in my hand. It wouldn't give me the same sense of security. Okay, so there's store value, and then there's medium of exchange. And when it comes to medium of exchange, you really don't need the price. All you need is the liquidity, the ease of acceptance. If I want to buy a car in Bitcoin, and I have, you want to transact in Bitcoin, it doesn't matter how many Bitcoin there are to it. It doesn't, because this is hard to explain. You just increase the transaction, you just increase the volume. Like, it worked the same to buy cars for $400 in 1920 as it does to buy them for $40,000 today. It didn't make any difference. Okay, the dollar is worth less, but the transaction is the same. So when it comes to moving money or paying people, I don't see that you need a higher price, that is going to drive the price higher. And again, on any time frame that matters to the vast majority of people speculating in Bitcoin, none of this is relevant. The fundamentals are not changing as quickly as the price. This is just markets doing what they do. This is just fear and greed, eagerness to buy versus eagerness to sell.
So to wrap up the Bitcoin thing. I think it's a little bit different than trading on, because it doesn't trade on an exchange. I heard there's talk with the CME or the CBOT. One of them is thinking about is going to trade Bitcoin futures.
Yeah, that would be great if we get Bitcoin futures.
So then I think that's an important. I think that makes it. I think the reliability exchange makes it important. Makes it tradable or not tradable. That's my conclusion, at least right now. We'll see where it goes. So this is. I have a few other points. If you want, we can discuss. Unless you have something off the top of your head that you want to discuss from the chapter.
No, off the top of my head.
So I think these are some wise things that Richard Dennis said. It is totally counterproductive to get wrapped up in the results. Trading decisions should be made as unemotionally as possible. You have to maintain your perspective. There's more to life than trading. Also, to me, being emotionally deflated would mean lacking confidence in what I'm doing. I avoid that because I've always felt that it's misleading to focus on short-term results. The flip side is that I also avoid the emotional elation when things are going well. There is no way to play just one side of that street. I wouldn't claim that I realized that after 3 years of trading, but after you've done it for 20 years, it either drives you crazy or you learn to put it into perspective.
I liked also how he said that if your trading is going against you, you have a bad run, just step away. You take a big loss, it's weighing on you heavily, just step away from the markets for the rest of the day, for a few days, however long it takes, and then come back fresh.
So that's one of the things that's counterintuitive to some people, especially people that have a fighting personality.
Yeah. Especially if you're doing things the old-fashioned way, you're not running a quant system where you have to take every trade that's given. Maybe you're trading by rules, but you're doing it manually. Your emotions are going to affect you, so you've got to be in the right frame of mind to be a good trading machine.
So I think that what he said with what trading is the more to life in trading is kind of self-explanatory. When you're younger, and I think to get good, maybe it's got to be the focus. But I think to sustain and be in the game over time, I think there's two interesting people in that realm. There's Warren Buffett and George Soros. So Warren Buffett's an investor, and he's been doing the same thing tweaking, but the same thing for a long, long time. And he has a methodology that I think lends itself to doing it in time.
Yeah, Buffett's investing is quite human. I don't mean folksy. I mean, he invests in the world of rationality.
Yeah, everything we talk about and being slaves to price and not thinking about the world, and the biggest fallacy markets are supposed to make sense. Buffett disproves that. I would say he's the exception that proves the rule. But
you have to, there is this whole other approach, which is not trading but investing. And if you invest, it matters what you're buying. It matters, you're buying, whether it's real estate or equities. You have to know what you're buying. You have to have an idea of what a reasonable price is. That's a whole different world, because you're not cutting your losses if something goes against you. You're not second guessing. You have to have conviction. It's just a whole different world. There's a whole other approach that goes with it. It works great over the long term. Over the short term, it's far more volatile, and it has long periods of low or no return, and so it can be frustrating to do responsibly, or to do if you can't accept the possibility or reality of 50% losses and being underwater, being in a drawdown for many years. Buffett has gone through that, and he'll admit that it takes that. But it's a whole another way to trade. It's a lot more intuitive, or to invest, I should say. It's far more intuitive.
So this brings up a question for a young person or any person that's going to go down the road. We're here discussing Richard Dennis and our preference of trading / investing. But if you look at, with the benefit of hindsight, we can say, well, look, Buffett had his methodology, which is in contrast to this, and he's the world's richest man, or this number 2 or 3, whatever it is. And Richard Dennis is kind of not a well-known person today. A lot of traders probably might not even know who he is. He left the game in 87, 88, and he didn't really come back as a known person. He didn't go on to become, he go on to become the Paul Tudor Jones and Bruce Kovners and Jerry Parkers of the world. So if we were to say we're 12 years old or 20 years old and we're starting out and we're saying, well, Buffett, we can go down the Buffett road.
Yeah, I would advise a kid to go down the Buffett road, because if you follow Buffett's rules are easier to understand. You have to learn accounting and learn about business, but they're just easier to follow. It's not that Dennis's rules aren't dead simple, but Buffett's rules are easier to follow, and they suit a wider range of personalities, I believe. And they will, for a random person of reasonable intelligence, you'll have a higher chance of success. There's certain success over a long enough frame of time if you follow Buffett's method. There's another method I wouldn't recommend either. I think
you wouldn't recommend Richard Dennis's method nor Buffett's method?
I mean, what we do, I believe, is the best, or even just the simple version. If you're young and
Well, let me spend a little time on that. Why does age matter? Why should a 12-year-old, or if you were to tell a 12-year-old or a younger person?
Age matters a lot. You can't recommend it for a retired person to do value investing.
Sure.
Because you can have such a long period. You could have such a big drawdown and a long period of underperformance. You could recommend for a retired person to do, if they wanted to learn something completely new and they had the inclination, you could try some kind of trading, but you would have to be very, very careful to watch your position sizes and follow the rules, protect your downside. The inefficiencies that Buffett exploited in his career are not as great now as they were then in the olden days. Furthermore, to the extent that they still exist, and they do, value and quality are demonstrable factors, they can be purchased in ETFs for low management fees. Pay a % a year and have somebody run essentially Buffett's rules and pick the stocks for you through a mechanical process. It's a mechanical quantitative process, but it's looking at fundamentals. It's reading balance sheets. So everything's a factor. Everything's been distilled down to simple rules. And I wouldn't. But somebody has to do it. I don't know. The economy still needs people to allocate capital efficiently. But that factor investing style does efficiently allocate capital. It will, in the case of a quality and value fund, it will not invest in an overpriced stock, and it will tend to give more towards companies that can generate a good return on investment. But there's an intermediate, which is index level value investing. Sort of like the Shiller PE market timing method, where every year you look to see how expensive the S&P is, and when it's expensive, you put more money in treasury bonds, and when it's cheap, you put more money in the S&P, and just you look once a year and adjust your portfolio. That's going to give you a strong risk-adjusted return without the worst of the downside that you're going to get from stocks, with a very good long-term return. And it's very easy to do. It's reliable, and it's easy to do. So that would be an intermediate method, which is not. That'll generate a very nice excess return per unit of risk over just buying and holding the S&P, or buying and holding 60% S&P, 40% bond portfolio. So that would be a good system.
So my obviously Buffett's a phenomenal track record and a role model to follow in the business. My personal issue with following Buffett might be partly due to personality. Mm-hmm. The other thing I think is it's tough for me to follow because I don't know where I'm wrong following Buffett's methodology. I don't see where the risk management is. Okay, there's risk management at the financial statement level, but anything can become an Enron. You don't know.
Yeah.
And number two is the time. Like I said, there's one iteration at life, and I don't want to wait 10 years to find out that it was wrong. Yeah. I like trading because you're constantly optimizing along the way, and I think it's a higher guarantee to a high level of success. You might not get to be the richest person in the world that way, mm-hmm. but it's a higher probability to me because you're constantly fixing along the way.
Yes.
To have good success.
If you follow the rules, trading has a higher probability of a strong performance record than value investing.
Right.
By strong, I mean, what would you say? Teens. If you start now, for the next 20 years, will you have compounded at 15% as a value investor versus as a trader? What if you want to try for 20? Is that at all possible? I'd say it's more likely as a trader.
I think so. It's where I'm making the bet. I'm making the bet.
And if you're young and you're playing with just a little bit of money, maybe you have the knack for it.
That's the other thing. I think I forget where. I think I discussed this in one of the videos. Is that young people sometimes come to me, or younger people come to me and ask me, what they should do to learn this game. And for a long time, I was kind of like, don't play this game. Like, get a real skill in your life and think about how to add value, make a contribution, because in the long run, that'll serve you better. But I don't think that advice would have worked on me. And
There's some hard-headed kids who just won't listen.
And I don't know if it's the right advice. I think maybe the best advice is to just jump in the pool and just do it and figure out if it's for you or not.
Yeah. Most people probably wash out if it's not for them anyway.
And if you start young enough, you have time to move on to
they'll find what works for them.
To be a contributing member of society. I got a few things here, but I can end with this one from my side, which is he said this. I don't think trading strategies are as vulnerable to not working if people know about them as most traders believe. If what you're doing is right, it will work even if people have a general idea about it. I always say you could publish trading rules in the newspaper and no one would follow them. The key is consistency and discipline. Almost anybody can make up a list of rules that are 80% as good as what we taught our people. I guess he means the turtles. What they couldn't do is give them the confidence to stick to those rules even when things are going bad.
That's right. There's nothing new under the sun. I mean, This book was published in the late 80s. It's 30 years old. This book is 30 years old now. And it all still works today. It's not a secret. It's just very hard to do.
I think we can leave it on that because I think people will only realize how hard it's to do by doing it.
All right, so until next time.
Thanks for watching.